Thank you so much for attending this breakout session for ESG Impact. We're going to focus on human capital and the role that ESG plays in the workforce, driving productivity and making the company more responsive and more responsible for all stakeholders, including employees. We'd like to hear from you. Please put your questions in the chat on the right-hand side of your screen, and we're going to get to as many of your questions as we can during the session. And right now, I want to introduce our featured speaker right now. I'm very happy to be joined by Cambria Allen-Ratzlaff, Managing Director and Head of Investor Strategies at Just Capital. Ms. Allen-Ratzlaff is also the co-chair of the Human Capital Management Coalition. That's a group of 37 large institutional investors representing $8 trillion in assets under management, and they really focus on the value and improving human capital. So Cambria, thank you so much for being here.
Oh, thank you for having me.
So first and foremost, we just want to jump right into this. We only got a couple minutes together before everybody gets back to the main stage. So when we talk ESG, the focus is often on the E with things like climate change and sustainability. Top of mind when it comes to that. How important are the S and the G when it comes to human capital?
They're both very important. So, when we think about the G, we're talking about the corporate governance. I always like to start with that because those are the policies, the processes, really the scaffolding that holds up the corporation. And, as investors, you're looking for a company that's well run overall, including operational success. And when we're talking about human capital, we are talking about the knowledge, the skills of the workforce. And it's incredibly important. Over the past 50 or so years, as we've moved from an economy and value focused mostly on property, plant, and equipment to an economy where it's really the talents of the workforce, the ingenuity, that special American factor that we have, that's where the value is. In fact, S&P 500, 17% of the value in 1975 was in tangibles, that PPE. Today, it's over 90%. So when investors are thinking about human capital, they're thinking about the value of the firm. And to your point, yes, when we hear ESG, the phrase, the jargon, whatever, we used to call it just investing. But I guess now it has a title. When we're talking about that, people are typically thinking about climate. But, here we have to focus on the workforce because that is really what's creating value for our companies at Just Capital. When we're polling the American public, number one issue every single year we've polled has been workers, the focus on the workers. And I think that makes perfect sense.
Right. So, of course, workers are, again, one of the stakeholders of a company, and we hear more and more companies saying they want to be responsive and responsible to all their stakeholders. For those of you just joining us right now, I want to remind you we're with Cambria Allen-Ratzlaff, the Managing Director and Head of Investor Strategies at Just Capital. Ms. Allen-Ratzlaff is also the co-chair of the Human Capital Management Coalition. That's a group of 37 large institutional investors representing $8 trillion in assets under management that also focuses on human capital. So we certainly have a lot of expertise here with us. And another reminder, if you want to post a question or a comment, on the right-hand side of your screen, there's a box to do so. All right, so there was some news today. I have to talk to you about a little bit of news. We're not just talking broader topics. We have some very specific news. The state of Louisiana is pulling almost $800 million from BlackRock funds, citing the asset manager's emphasis on ESG. What's your reaction to this? A lot of people are going to call this a partisan decision, but what's your reaction?
I think some of that's fair. I think it's also a lack of understanding when we say ESG, what we're really talking about. And the term isn't well defined. So that creates a lot of problems. And that's actually where my concern is. The pulling money, first of all, pulling money out in this economy right now, especially in public equities, is a rough way to go. And I think, these previous efforts that we've seen in other states, they have cost taxpayers money. The state of Texas, when they prohibited came out against ESG, 5 of the largest bond underwriters exited the market. That is expected to cost taxpayers in Texas in the first 8 months of that between $300 and $500 million. So the concern is that when we're talking about ESG, we're talking about data. It's data. There isn't an investment. You might use an ESG in an investment style, but you're talking about data. If BlackRock the largest money manager in the world, over 8 trillion in assets, is saying, okay, well, we need to consider some of these factors like climate risk, how well companies are managing those risks, energy transition. Not everybody is looking to pull out of energy companies. I think, as Jennifer Grancio mentioned earlier today, we still need fossil fuels to drive that push toward cleaner energy. As we're doing those things, these are business decisions. They're investment decisions. You just don't want to be in a position where you're limiting investment staff from making the best decisions possible. And that's kind of what these things do. So it's very, very concerning. And, the American public is aligned on what they're expecting out of companies across every single demographic group, income level, political persuasion. The number one issue in our polling for the American public is companies paying a fair and living wage. Number one across the board. Makes sense. These are kitchen table issues. So I think we really do need to focus much more on the economics and the performance than some of the noise that's kind of floating around right now.
Well, you were having a busy day. We got to text a little bit. We didn't get to talk. Is BlackRock part of your Human Capital Management Coalition?
They are not.
They're not. Okay. So just if you're a BlackRock, you're someone who has a lot of insight about companies like this that are asset managers. Does this discourage you from being focused on ESG to see the state of Louisiana pull money? I mean, $800 million is certainly a lot of money, but BlackRock has a lot of assets under management as well.
No, not at all. I mean, as you mentioned, when people think ESG, they do think about climate. I view, it's hard to say, that labor within a company is somehow new, or it's managing an externality. That's a direct input into the operations of the firm. It's always been that way. It's labor capital. So I think, so I'm not totally concerned about that. I think that, the members of the Human Capital Management Coalition, we actually don't view, because of that, we don't view labor as kind of an ESG issue in and of itself. And so, I think that there's a lot of rhetoric, but we really focus on the substance. And the reason we came together back in 2013, before COVID, all of that, was because we were concerned that as investors, we didn't have good data to understand how well a company was managing its workforce. And that puts you at a huge disadvantage. If you have better data, you can make better investment decisions, better decisions about how you allocate your capital. Also lowers the cost of capital for companies that are well run, that manage their people better. So all of this, again, it's all about the bottom line.
So we had to hit on some of that news from today with the state of Louisiana and BlackRock. Again, the state of Louisiana deciding to pull almost $800 million from BlackRock funds, citing the asset manager's emphasis on ESG. Let's talk a little bit broader right now. How would you characterize the current environment when it comes to accessing talent, even as we see the economy weakening? Where do you see the balance between employers and employees?
Yeah, so I think that we're in a situation where some of that's a little uneven, but there's still, we're still seeing pockets where employees still have, more bargaining power. And I think that that's not going to change really anytime soon. Obviously, the JOLT report's a little, concerning. We'll see what happens with the jobs report tomorrow. But I do think that we still are in a time where the expectations of what a good job is has shifted dramatically. So I think that, over the long term, we'll see, higher quality jobs and employees and employers really negotiating more on a level playing field, maybe not totally level, but closer to that than I think we've seen in the past.
All right, we want to encourage people to ask questions on the right-hand side of your screen. You can ask a question. I'm going to go to this one question that kind of follows up on the discussion we're having right now, Cambria. Yeah. This is from Shelley Geyer. It says, following up on the Tesla discussion, how does one evaluate their human capital issues? Ratings, fighting against the state of California, care for employees in their manufacturing facilities, moves to China, and this is in parentheses, and how do they treat their workers there? So a lot to unpack there.
Mm-hmm. Yeah, so things. Yeah. So, I mean, Just Capital, we rank the Russell 1, so the largest US companies, but we don't assign ratings to them. It's a relative process. Ratings are a little more absolute. And I think that, Tesla, I'm assuming that Shelley might be referring to, Tesla getting dinged on their ESG overall, I think earlier this year. And, there was a lot of talk about that because the response was, well, but they're an electric car manufacturer. That's all climate. But the reason was the workers and the way that the company, treats their workers, concerns about equity, discrimination, poor job conditions, health and safety. And I think actually that underscores the importance of making sure that as we are transitioning to a cleaner, energy economy, that you don't leave the workers behind. We're always talking about climate, but part of that is also making sure that workers who are in those industries, the fossil fuel industries, that they can be retrained, they have opportunities to kind of take advantage of that pie as well. I think that's my guess is that's kind of where a little bit of that is going.
So can I ask you just a general question? I think a lot of us would want to know. It made a lot of headlines a couple of weeks ago, maybe even a month ago. Time seems just hard to understand these days. Elon Musk was reportedly telling everybody they need to come back to the office and work in the office 5 days a week. So depending on where you work, what industry, some people would see that as, oh my goodness, I can't believe you're making us come back. And other people just accept it. Where does that kind of factor into your thought of ESG? Is flexibility for your workforce something that you see as being crucial, or is that voluntary and optional?
I think it depends on the workforce. So, I think what we learned in the beginning of the pandemic is when, a lot of the office workers, I'm here in my house, my dining room, shifted to working from home. First of all, productivity increased. But second of all, it's like, oh, okay, well, if I can grab my laptop and do my work from wherever I am, why would I need to come into the office? And I think that tension is, certainly still there. I think that, that is a business decision, and investors have to think about, okay, well, does that limit Tesla's ability to recruit the best talent? Because that's really what we're talking about, a lot of this. Does it limit their ability to ensure workers are engaged, or are they sitting at home thinking, well, why am I driving an hour to the office when I can do everything here and do it better? So I think that's, those are some of the questions that investors will be asking and trying to understand over time.
Yeah, I've personally been trying to convince CNBC I'd just be more efficient working from Barbados. They just haven't bought in yet. On a serious note, we do have another question. This one from Kim Kelly. She asks, how do you see companies transition wage and labor data based on 1965 job and career pathways to skill-based careers with lateral and vertical career growth? And how will, again in parentheses, or how will it, that help achieve fair and livable wages? So again, a lot to unpack there, but it seems like the main question is achieving fair and livable wages.
Mm-hmm. Yeah, I think that's a really great question, because we're talking about different expectations from jobs, but also what's expected of employers. When we had sort of these manufacturing-based jobs, they also came with full health benefits. They came with full pensions. They came with inducements for employees to stick with that particular employer. And going back to kind of the last question that we just discussed about remote work, those expectations have changed both for the employer and the employee. And so now the employer is in a situation where they are competing with whoever else will hire, based on your work function. There's a lot more mobility among employees. So I think that's hugely different. And I agree. And talking about sort of the data that we still have an information cycle that gives us data from that PPE 1975 time. We don't have good information, although we're trying to get it, but we don't have high quality information that could help us assess how well companies are managing their workforce today. So I think that's, there are a lot of factors at play, but I think that question goes to the heart of, really what we're talking about here is that there's still competition for talent. There will always be competition for talent. So what does that mean? What does that mean for investors?
Oh, we're actually getting a lot of great questions. Kim Schaefer has another question. How important is regulation requiring mandatory human capital data disclosure?
It's very important. It's extraordinarily important. So right now we're in a situation where all companies are required to report on publicly traded companies in the U.S. By regulation are required to report on publicly the number of employees at the firm. And then there is an add-on that is about 2 years old where companies are required to report on human resources to the extent that the company views that as material to their operations. Now, because it's an open-ended question, you get open-ended answers. And what investors are looking for is a way to quickly assess and quickly understand, assess, and then make decisions based off of high quality decision useful data. And a lot of what we're seeing is none of those things. So really having the regulators step in and provide a foundational bucket of information would be extraordinarily helpful. So the HCMC for the past several years has been advocating for this at the U.S. Securities and Exchange Commission. And those metrics, we want to see the number of employees, but we want to see it broken out by full-time, part-time, and contingent/contracted labor. We want to see turnover data. We want to see the total cost of the workforce. It's very odd that you can't even get that in the U.S. Everything's pumped in with desks and chairs and computers. It can't tell how much you're spending on your workforce. And then finally, basic diversity, equity, and inclusion information. So especially among the highest ranking employees in a firm. And the reason for that is, again, we're going competition. We want the companies, the winners are the ones who can recruit from the biggest pool possible. And those are the ones that you want to invest in. And companies that reflect that in their numbers, that's the best bet for you.
All right, we have another question from Eddie Roberts. Do you see a future where employee satisfaction, possibly based on structure, entry, mid-level focused, becomes a metric for evaluating a public company's financial profile? Factors such as salary, competitiveness, management ratings, consistency of philosophy, internal and external, etc. Oh,
yes. Yes, I do. Especially when you're thinking about and I'm sorry, I'm just reading this as well. When you're thinking about very detailed questions, if you're a long-term employee investor, then absolutely. And I think that does flow. There is definitely a through line between some of the data I mentioned and to the financials. And actually, one of the other areas that we've been pushing on, and actually we just discussed at the SEC's Investor Advisory Committee meeting in June, is improving the accounting to include the total cost of workforce in the financial statements on the income statement. So, there's a link between some of the other pieces I mentioned, like the turnover and the financials. And actually a group of academics in June petitioned the SEC to require just that type of information. So labor costs, but segmented out as well by those employee categories, the full-time, part-time, contingent, the turnover as well. So I think absolutely, it's a missing piece. It's a huge missing piece. As I said, 90% of the S&P 500 now is in intangibles. That's the value of a firm that we can't see.
Just a follow-up question. Great question, Eddie Roberts. I know you guys put out a list of, companies when it comes to pay equity, whether it's on racial lines or other criteria. My question for you is, do you want investors to take that, I guess, not more seriously, it's a very serious topic, but consider it more when they're making investments, especially large institutional investors like the group that you're the co-chair of, the Human Capital Management Coalition?
Oh, well, it's not what I want. It's what they want. Investors have been pushing for more information on pay equity for years. You can see that in actually some of the shareholder proposals that have been filed at companies. And those are filed when talks break down and investors are frustrated and they're like, okay, well, let me ask all the other shareholders, do they also want this too? So pay equity has been a topic of conversation for a very long time. And, even you look across the pond, the UK has had pay equity disclosure requirements for the past, 4 or 5 plus years. So again, this is definitely not a new conversation. And, for us at Just, we provide data to the market that they can use to make decisions. That's it. So.
Another question from David Grossoff. I'm wondering about the possible value of revising ERISA. I'm not familiar with this, but ERISA. So So the beneficiaries of pension funds can themselves have the power of decision rights as shareholders to vote their interest in corporate governance. Currently, non-financial considerations are forbidden, but maybe fund beneficiaries should have the power to direct an otherwise, let's just say a corporation to control its externalities and treat workers well.
Yeah, no, and it's it's the Employee Retirement Income Security Act, I think I said that right, of 1974, that David is referring to, and I'm very familiar with it. Before being at Just, I was on the asset owner side for most of my career, both a pension fund and an ERISA regulated fund. So can definitely speak to this. So one thing that I think is interesting here is the idea of non-financial considerations being forbidden. And that's true. You have to treat pensioners' money in a way that makes the best financial decisions for them. And that makes sense. It's not my personal money, it's theirs. And so you want to invest it and treat it in a way that maximizes their returns over time. And that's really, really important. So a pension lasts, you work 30 years and then you get your pension, your time horizon's a lot longer. And that's actually where I see there isn't really as much of a tension as I think people often think there is between the financial performance and making sure that these stakeholder types of issues, or the labor, which is foundational to the firm, is attended to, and a company pays attention to how well they perform for those stakeholders and labor, because companies that, again, better managers make better longer term investments typically. So I don't think that there needs to be that much of a tension, but yeah, I mean, it's been a bit of a football. Every single time there's a new administration, there's a change to ERISA rules. And that's probably going to still be the case. But at the end of the day, just please remember, it's about the bottom line. You don't have to make these value versus values trade-offs. You really just don't.
All right, we're almost running out of time. So I just want to give you a chance. Is there something on your mind? Is there some ideas that you want to get across? I mean, obviously you have so much experience in this area and you're dealing with this day to day.
Yeah, so I think, one of the key factors, I think we kind of started with a little bit, and at the risk of being political here, is that, just polling again is showing that we are more aligned than we think. And as we are, digesting the news of the day, sort of the flavor of the week, just to really remember that it's about the kitchen table issues at the end of the day. And that includes jobs, making sure that we're creating good, solid jobs, that companies are paying a fair and living wage. That's the number one issue, as I mentioned. Number two issue is creating jobs in communities. So again, I just want to really, really stress that, as well as, push for higher quality information. And we do need that regulatory solution as well. So.
All right, before we let you go, one last really quick question, because we're almost out of time. Actually, Ryan called me with another question, but we're almost out of time, so you have to make sure the answers are kind of quick, Cambria.
Yeah.
How big of a challenge do companies have in aggregating their data to make decisions for ESG initiatives in order to comply with regulations?
That's an interesting question. I don't know, actually. You would probably have to ask the companies themselves. I mean, there's some companies that have been doing this for years. And that's just part of their strategy, and that makes perfect sense. There are others that might have to play catch up. But right now, the regulatory demands on companies are pretty basic. So we would expect that, again, a company is able to, if you're a large U.S. publicly traded firm, you're kind of an adult company. You should be able to take care of this and continue to make value for investors.
All right, we're going to have to leave the conversation there. Thank you to Cambria Allen-Ratzlaff, Managing Director and Head of Investor Strategies at Just Capital. She's also the co-chair of the Human Capital Management Coalition. That's a group of 37 large institutional investors representing $8 trillion in assets under management. We really appreciate you being here and sharing your insight. Thank you again.
Sure. Likewise. Thank you.